Hi folks, and welcome to this video on recording merchandising transactions using a perpetual inventory system. In this case, our company Duval is making purchases from their suppliers and sales to their customers. And what we're going to do is record all the journal entries that relate to the October transactions for Duval, assuming a perpetual inventory system. And we're also going to calculate the value of ending inventory on October 31st after all these transactions are journalized. So let's begin. So now, in the first case, Duval bought or purchased from their supplier Hoyt inventory in the amount of $30,000. So this means that Duval's getting inventory. So when we're getting an asset, inventory is an asset. If we're getting it, it's getting bigger. It gets bigger on the left, and left means debit. So we're going to debit inventory, and we're going to credit our accounts payable. Accounts payable is a liability. That's the amount that we owe Hoyt. So that's going to be credited, that liability, meaning it's getting bigger for $30,000. Now, on October the 6th, Duval paid a supplier that they purchased goods from in September. So these goods that we're dealing with now have nothing to do with the ones on October the 4th because they were purchased in October. All we're saying here is that Duval is paying a supplier for goods they bought in September, and they're paying them $12,000. There was no discount on this, so if they're paying off their bill, they're going to debit or reduce their liability accounts payable and pay it off with cash. So they're going to credit cash $12,000. Now, on October the 7th, something different happens. Now, Duval is selling to its customer, ABC Company, for $20,000. And ABC, if they pay within 20 days, can take a 3% discount, but they have to pay the bill within 30 days. The inventory that Duval is selling to ABC, Duval originally paid $10,000 for it. So because we have a perpetual inventory system and we're doing sales transactions, what do? Two things. Record the sale transaction, number one, and then number two, get rid of the inventory because Duval's shipping it out to ABC Company. We get rid of the inventory at what it cost Duval to buy it, which is $10,000. So the first entry records the sale to ABC. So we increase our accounts receivable because it's a credit sale. We debit AR and we credit sales revenue for $20,000. But once we've recorded that sale to ABC Company, we have to get rid of the inventory because we're shipping it out. So we're going to credit inventory and debit our income statement account cost of goods sold. Remember, the cost of the goods that we sold to ABC Company was $10,000. So this account name actually is very representative of what we did. We're getting rid of the inventory at what it cost us to buy it, and then we're turning around and selling it to Duval or to ABC Company, right? So we debit this cost of goods sold account, which is an income statement account, and credit inventory. Now, on October the 8th, Duval decided that $3,000 of the inventory that they purchased from Hoyt on October the 4th, you remember that up here on October the 4th, it was the wrong color. So they decided, Duval that is, to return it. So what's going to happen? Well, on October the 4th, they thought they owed Hoyt, or they were going to pay Hoyt $30,000. But they're not going to pay him $30,000 now. They're going to pay him $30,000 less $27,000. So they're going to reduce the account payable by $3,000, and they're going to return the inventory that they put in at $30,000. They're going to return $3,000 of it. So we debit AP and credit inventory. So we're crediting an asset account. So we're reducing it by $3,000, and we're reducing the amount that we owe Hoyt, which is by $3,000. So now what happens? On October the 12th, Duval is going to pay Hoyt what they owe them. But notice the original purchase Duval made from Hoyt happened on the 4th. Are they going to pay them with a discount or not? Well, because they had 10 days to pay, and they're now paying on October the 12th, that's only 8 days after the sale happened. They had to pay within 10 days, so 8 days is within that period. So now Duval's going to take a purchase discount. So how do we record it? Well, first of all, we're going to reduce our liability By how much? By $27,000, because the original liability was $30,000, but the liability after the return was made, we deduct $3,000. We're going to clear off, when we make our cash payment, $27,000. So how much cash are we paying them? Well, we're not going to pay them the full $27,000. We're going to pay them only 98% of it. So how I get 98% is that $27,000 is 100% of the bill, but we're not going to pay them 2% of the bill. Why? Because we're taking our discount. So we're only going to pay them 98% of what we owe them, which is 98% of $27,000, which is $26,460. So the other $540, which represents our 2% discount times the amount we owe them, is credited to inventory. Why are we crediting inventory? Because all purchase discounts are charged to inventory. So what that means is that instead of us paying $27,000, and the inventory costing us $27,000 to buy. See, we set the inventory up here at what it cost us and then return $3,000 of it. So after we make our return, the inventory is really sitting there at $27,000, which is what we would have paid for it. But because we took a discount, we're going to credit our inventory by the amount of the discount. So we credit inventory for $540. So all the purchase discounts we take, we credit directly to inventory. So now what happens on the 14th is our customer, ABC Company, returns some of the merchandise they bought because it was the wrong size. So we shipped them the wrong size. So we had in our records that we were going to charge them $1,500 for the goods that they returned. Remember what happened? On October the 7th, we set up a receivable of $20,000, but $1,500 of that stuff is being returned. So we're going to reduce our accounts receivable, the amount of the receivable we expect to get from ABC Company, by $1,500, and we're going to debit it because we want to track our sales returns and allowances. We're going to debit it to sales returns and allowances, which are $1,500. Remember, the sales returns and allowances account is a contra revenue account. It has a debit balance. But the other thing we're going to do, because it's a perpetual inventory system, is don't forget that $1,500 that we're going to reduce the receivable by and debit the sales return allowance account by. The original cost of that inventory to us as Duval was $750. So what are we going to do? Well, when ABC Company ships it back to us because it's the wrong size, we're going to put it back into inventory because we know we can sell it to somebody else who wants that size. So all we're really doing is we're undoing or reversing this entry that we made on October the 7th. We're reversing it by $750 because we're going to restock the inventory and credit the cost of goods sold by $750. We're just going to reverse out what we did here. Remember, on October the 7th, we said, well, we're going to remove $10,000 from inventory and charge it up to cost of goods sold in the income statement. But really, because ABC Company is returning it to us, we're going to restock it and just reverse out the debit to cost of goods sold. So we're going to credit it by $750. Now what happens? On October the 24th, ABC Corporation paid us what they owed us. So how much did they owe us? Well, let's have a look. Don't forget, on October the 7th, we set up our account receivable at $20,000, and we reduced it by $1,500 because ABC Company returned $1,500 of the merchandise they bought from us. So that means that we're going to reduce our account receivable by how much? $18,500. Don't forget, we can't expect ABC Company to pay us for the $1,500 in merchandise they're returning. So whatever payment they make, they're clearing off their account receivable in full. So now how much money are we getting from ABC Corporation? Well, if they only owed us $18,500, we're going to get 97% of it. How do we calculate that? Well, the full amount of the receivable was 100%. But don't forget, because they're paying within the discount period, they're going to pay us 3% less than 100%, or 97% of the account receivable balance, which is 97% of $18,500, which is $17,945. Now remember what we said that was very particular to selling transactions, and that is that most companies will track their sales discounts. So now sales discounts are going to be recorded here by Duval because they want to track how much of a discount our customers take, and the customer is taking the difference between the cash we received and the receivable we're clearing off our accounts, and that's $555. But we can calculate that. $18,500 was the amount of the receivable that we as Duval had in our books that ABC company owed us, but they took a discount of 3%. So we're going to debit the sales discount by $555, which is 3% of $18,500. So now, what I asked you to do in part 2 is to calculate the October 31st inventory balance, given everything that's happened. But you'll remember in the question, I asked you to assume that at October 1st, you had inventory, beginning inventory of $6,000. So what happened? Our inventory started at $6,000, but don't forget, on October the 4th, we bought inventory of $30,000. We also cleared off inventory on October 7th of $10,000, right? So if we had a look here, I don't know if I can do this, but if we look at what happened to our inventory, it started at $6,000. On October the 4th, we bought inventory from Hoyt for $30,000. And don't forget, we sold merchandise on October the 7th to ABC Company, right? So we reduced our inventory by $10,000, right? And then don't forget, we returned some inventory to Hoyt because it was the wrong color. That was on October the 8th. So we credited or reduced our inventory by $3,000. And then don't forget, we took a purchase discount, which reduced our inventory over here on October the 12th for $540. And then don't forget, we also increased our inventory by $750 when ABC Company returned merchandise that was the wrong size. All we did was restock it because we can sell it to another customer, and that increased our inventory by $750 on October the 14th. So in total, we have $23,210 in inventory. So that's how we went from our opening inventory to our ending inventory here of $23,210. We had our purchase, right? But we also had what we sold to our customer less the amount that we returned to Hoyt, less our purchase discount that we took, plus the amount of inventory that we restocked when our customer ABC Company returned inventory because it was the wrong size. So this gives us ending inventory of $23,210. So I hope you found this question helpful in helping you understand merchandising transactions. I know this is a challenging topic for students, but just make sure you know how purchase transactions are different from selling transactions. So hopefully you found this video helpful.